Welcome to the TIP Wealth Builders podcast, where we bring you insights, strategies, and stories to help you compound your wealth and knowledge. I'm Kerry Fleming, your host for this exciting series. So whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you. Let's get started. Today, we're kicking off our very first session by exploring who TIP Group and Teaminvest are, what makes us different, and why our investment methodology stands out. Joining me today are TIP Group CEO Andrew Coleman, Head of Funds Management and Education Sanjee Narendran, and Corporate Advisor Pete Hasrouni. Each of them brings a wealth of experience and unique perspectives to the table, and I can't wait for you to hear their insights. Okay, let's start by hearing from our CEO, Andrew Coleman. Thank you for coming on today.
Thanks for having me.
Andrew, give us a little bit of the history of TIP Group, how it came to be, and also how Teaminvest fits into TIP Group.
Absolutely. So in the late 1990s and early 2000s, John Price, who at that stage was head of mathematical finance at the University of New South Wales, was fascinated at understanding how it was that Warren Buffett and value investors, real value investors like Warren Buffett, could historically beat the market with great regularity when, of course, under the efficient markets hypothesis, that should be theoretically impossible. And so John set about doing a whole bunch of research to try and understand what quantitative factors enabled an investor to beat the market, and found, like many, many academics before him, that they didn't exist. But what he did find was that the inverse was possible, that whilst you couldn't use quantitative factors to pick winners, you could use quantitative factors to identify losers. And of course, if you have an average of the whole market and you were able to just exclude the worst performers, then by definition, what you would be left with would, as an average, do much better than the market. And in John's case, by about 800, 900 basis points per annum, which of course is a huge outperformance. And so John set about understanding whether there was a way to implement that kind of an investing strategy. And he met Howard, Mark, and Regan socially, and they got together and formed Teaminvest, which was originally just trying to identify two things. Firstly, a methodology of putting in place that quantitative methodology, but also adding to it the bit that was obviously missing, because when you're looking at any quantitative series of measures, there's obviously the big risk that you are left with false positives, items that really shouldn't have passed, but due to some statistical anomaly fall through. So, a company that's a dog masquerading as a unicorn. And so together they organised Teaminvest, and over time continued to expand that to where we are today, of course, which is where we have over 600 high net worth and institutional investors managing over $1.6 billion in funds under advice. We're directly managing over $300 million of funds under management. And of course, we advise companies from not small businesses, but medium-sized businesses all the way up to large multinationals.
Wow. And how long was that period?
Well, John's original research was in the late 90s and early 2000s, but Teaminvest itself was formed as an organisation in 2007, TIP Group since 2013. So I don't know how many years that is now, but more than I probably want to admit.
But probably enough to have that methodology tested.
Absolutely. And well, over that 24 years that we've been tracking our performance since 2001 and the first iteration of the quantitative methodology as a portfolio rather than just as a theory, we've achieved an average compound annual return of roughly 19% per annum, which is approximately double the market. And as far as we're aware, very hard for someone else to beat. And certainly in the 13 years that we've been running funds management and private equity, we've achieved a 2.7 times money on invested capital in private equity. So that means for every dollar in, $2.7 back out. And in funds management, a net return to our investors of about 300 to 400 basis points above the market after fees. And of course, the classic problem for most fund managers is they're very happy to report you their returns before fees. It's just unfortunately that the fees you pay mean those results don't look quite as spectacular. We only stick to after fee returns.
Wow. And that's a pretty good innings considering the market cycles that we've been through and what we've seen happen in the markets during those periods.
Yeah, absolutely. And I think our big advantage is we're not trying to be the smartest people in the room. I think the classic problem in the financial services industry, and probably in all industries, but I can only speak to the one that I've had the most experience in, is that the market is set up such that you are constantly trying to seek great tips or great wisdom from people who present themselves as knowing more than the crowd. And in the immortal words of Benjamin Graham, Wall Street is the only place in the world where you arrive in a Rolls Royce to get advice from someone who caught the subway. And I think that's our big advantage, right? We're not trying to pretend that we know more than our clients who are experts in their field. What we're saying is two things. Number one, we can help you identify bad investments and stay away from them. And then number two, we can use the wisdom of the crowd of you and other incredibly successful business people and life people out there in order to winnow down what's left to remove any further false positives so that the portfolio you're left with, whether that's in listed equities, private equity, property or alternative assets, is a portfolio that is going to beat the market just because you've excluded all the things that would drag the market down.
This is true. And the thing is, that's probably actually a really good segue to actually have a look at what our methodology is. So you've alluded to us having a methodology, and that it's a methodology that is based around research that Dr. John Price did a number of years ago. So we might move to you, Sanjee. Can you give us some information about that methodology, how it works, and the uniqueness of it? Why is it unique?
Well, what we do is unique because we don't actually try and do a prediction. We're not speculating. We're not trying to guess what's going to happen in the future, whether it be a quarter ahead, a year ahead, 5 years ahead, or whatever.
Yeah.
There's no way to see that future. So you've got to just deal with the information that you know. So John's original analysis or his research was based on 80% of analysts not being able to predict what's going to happen a quarter ahead.
That's a scary fact, right?
Yeah, that's right. Well, 80% of the time, professionals in the industry are getting it materially wrong when they're trying to pick a quarter ahead. What's going to happen to these stocks?
And the majority of Australians have money invested in the market.
Exactly.
Even if you're not thinking about it, you've got your superannuation.
Super funds, yeah, exactly. So based on that, John's gone deeper, and he's, as John is that special type of guy, it's that second and third order thinking, and go in to find out, well, when they get it right, what is that based around? And it's based around stability of companies. So if a company is stable, you're more likely to make a far better far accurate prediction on it than if it's an unstable company or a cyclical company, which can turn with the wind. So the idea is to use a stable company as a base and then identify all the key factors that make it stable and really focus on not just finding those stable companies, but more looking for reasons to knock companies out. So if you're holding the index and you want to outperform the rest of the index, it's simple. The index is an average of the listed companies on the exchange. Hold it, get rid of all the dogs, and then what are you left with? An average that's going to outperform the rest of the market index. Simple mathematics, right?
Yeah.
So by turning it around, John really took a different approach to viewing companies. Then when he joined in with Howard, Regan, Mark, and they expanded on it, they didn't just follow the quantitative side that John came up with. They added a whole lot of qualitative research to go on top of that. And it wasn't just qualitative and speculative research. Even what we do at Teaminvest on the qualitative side, we bring in a wisdom of the crowd, and that process is research-based as well. So if you look at the wisdom of the crowd theory by Sir Francis Galton in the 1800s, he went around to different fairs and carnivals and things like that, where they would do the weighing of a cow or weighing of a sheep, and people would put in their guesses. And what he found was the guesses ranged so vastly. But the average of the guess was always closer to the actual weight of that animal than collectively or individually. So what he realized was, if you go out and get an average of a large enough sample size of educated or similar, like-minded or familiar people, then your average is going to always be within one standard deviation of what the actual is. So we apply that research to our methodology. So when we look at a company, the idea is to do a due diligence on that company as if you were buying the company in its entirety. You really want to understand the company. You want to understand its strategy, what moats it has that keeps its competitors away, what risks they're exposed to, how trustworthy and capable the management are. And when you go through and understand that and rate it, you use the wisdom of a crowd. Well, our crowd has 600 high net worth members across the country, all from different backgrounds. We've got lawyers, doctors, engineers, accountants, IT professionals, CEOs, and they're able to bring their experience, their education, their qualifications all into contributing to that wisdom of the crowd. Give us those insights that a normal analyst doesn't have the time to get, or they don't have the time to build up that experience to get, and contribute to that knowledge to understand those businesses and why those businesses are solid, well-run businesses that can continue running through different economic cycles, through turbulent times when there's headwinds and tailwinds. These companies can continue to operate and continue to grow their earnings. And we know if a company's profitable, continuing to make earnings, doesn't take undue risks, then the chance of that company being a wealth winner in 5-10 years' time is statistically way more likely than anything else.
So if we have a look at the methodology kind of in a nutshell, then we've gone through the research that was done by Dr. Price that we talked about,
Yes.
that has a look at the companies, how they're performing, and identifies which ones are potentially wealth winners, as you mentioned.
Yes.
We then add in the wisdom of the crowd, which again is a methodology that has been researched and tested over time, as you mentioned. And we use both of those, which are proven by research, based in facts, to make our decisions as to which are the companies that we would look at investing in.
Absolutely. And we keep finding reasons to exclude companies. And it's only till a point where we don't find any reason why we would exclude this company that we would then consider it a wealth winner. So once we've done that, then it's just about finding what is a correct and fair price and a fair valuation of that company. And when the market gives that to us, then we back up the truck and invest in.
That's the time.
Yeah, that's it.
That's awesome.
Kerry, if I could just add to that, because it might be
Absolutely.
useful for people who aren't familiar with our process. There's approximately 2,000 companies listed on the ASX. Of those 2,000 companies, at any point in time, only approximately 50 to 60 will pass the 27 quantitative filters, which are signs of a potential dog. Now, we're not saying because it fails one of those filters, it is a dog. We're just saying there's a greater likelihood that that is likely to be an underperformer in the future or too hard to predict.
Yeah.
And of the remaining, say, 50 or 60 companies, which is now a much easier set to analyze, what we're doing is using the wisdom of the crowd to get that down to a portfolio of, say, 15 to 25, depending on the period, to enable us to then invest in really the best of the best. So it's a two-stage process. Firstly, utilizing simple quantitative filters to exclude potential losers.
Yep.
And then secondly, drawing upon that wisdom of Sir Francis Galton and, of course, the foundations of modern statistics that then followed around independent sampling, that enables us to break that remaining subset of, say, 60 potential unicorns down to, say, 20, where you've got a lot more certainty that they are going to be able to continue perform going forward and therefore deliver an appropriate return. And then, of course, the final stage in that process, and the one we haven't talked about, but I'm sure we will in a future episode, is about understanding what price you can pay for these wonderful businesses, because it's all well and good knowing it's a wonderful business and it's not going to go bankrupt. But that doesn't help you if you've paid 3 times what it's worth. But we'll cover that, I'm sure, in a future episode.
None of us want to overpay for anything,
Absolutely.
right?
We all want a discount.
Absolutely. Absolutely. And I'm guessing one of the things that we would be looking at with companies that we invest in is their values. Every organization has a set of values that they work towards. And ultimately, it's important that those values align. So we might move on to you, Pete. TIP Group and Teaminvest has a set of values that we work towards. Can you elaborate on that for us?
Thanks, Kerry. If I reflect on how we work at TIP Group, values are the cornerstone of how we work and what we do, and they animate the work that we do. If we think about how that plays out in the day-to-day of our work, we start with, we believe being better investors makes us better business people, and being better business people makes us better investors. And at the core of that is a genuine insight into how we create value, how we lose value, and what effect that has on business. Then have a look at, we believe noise contributes more to error than bias, and irrespective, we seek to reduce both. And particularly in volatile, uncertain, complex, ambiguous times, making those distinctions is very important, that you can attribute either noise or bias and then reduce. If I think about one of the values that resonates the most with me personally in the work that I do, it's around complex decisions are hard and simple decisions are easy. And we seek to make decisions easy for our customers, our stakeholders and our team. And certainly in advisory work, trying to distill a complex, transitional, difficult environment is really how we look to improve outcomes for ourselves as business people, or certainly for our customers. And that's, I think, especially important in the times we find ourselves in.
Absolutely.
Even small changes compound over time. And I think when I reflect on some of the inertia we might find ourselves in this market, if you do nothing, you compound nothing. Even if you do something little, then over time that can have a material effect on the outcomes that you're getting, or the returns that you're generating, or even any journey that you're seeking to progress. Do nothing, achieve nothing.
Yeah.
And finally, factfulness beats running with the herd in the long run. Even if being factful can make us unpopular, in an era of alternative facts, we're firm believers here in actual facts, truthful facts. And sometimes that can be unpopular. Sometimes there are none so blind as those who will not see. And I think that fearlessness in being truthful and being honest is really a lot of what separates us from the crowd with respect to the truth genuinely is the truth. And we really do want to share those truths with certainly internally as a team and with our clients and stakeholders. And then if I reflect, what effect is that in our work? It's really about, in my earliest conversations with Andrew, taking really complex, challenging, vexing problems and solving them for our clients. Yeah. And I think if you find yourself caught in an ocean of noise, alternative facts, whimsies, changes of heart and mind, then seeing quite clearly through the noise, being factful in your approach, understanding the power of compounding is a great assistance to our clients, because sometimes the urge can be to do nothing if you're not sure, and sometimes pausing in a complex series of events is valuable, but doing nothing compounds nothing. So we've been quite, I think, forthright and fearless in our advice, in the work that we do, to really try and help our clients understand where the long-term value is, what the right moves might be, and of course, how to make them.
Absolutely. And I think the big things that you hit on there are factfulness, reducing the noise, and making difficult things simple. If we think about everything that we've spoken about today, we've gone with things that are based in research, that are, how do you say, duplicatable? Is that a word? We can repeat those. And they're based in factfulness. So like you said, when the noise is all coming at us, which at this point in time, it's really coming at us, and there's a lot of noise and there's a lot of fear coming with that, to be able to kind of, I guess, shift back the noise and go, okay, what is actually the truth, or what are the facts in this? And to have that solid methodology of this is how we work in this is such a relief in this time.
Yeah, absolutely. I think there are three things that we all have access to, regardless of what's happening in the world, that compound. And if you believe that compounding is the eighth wonder of the world, and that it will enable all of us in time to get ahead, we really should be trying to not only take advantage of those three individually, but put them together. And of course, those three things are our wealth. Our wealth can compound interest, compound returns. The second is our knowledge. Our knowledge compounds. Not only do we gain knowledge and we share it, but it builds upon the knowledge we have. And the more we share it in a process, an iterative process with the wisdom of the crowd, the greater our knowledge builds. And then thirdly, it's our culture. We do share our culture, and I think we've all unfortunately been in circumstances where we've seen culture compound both positively, that's good, and unfortunately negatively, which is not so good. But if you can organize your life or your investing methodology or your family, friends, or your whatever it is, your work life, around getting those three elements to compound together rather than compound against each other, that's when you can get material long-term change. And I think that, that you mentioned the replicability of research-driven outcomes. That's just an element of compounding knowledge, wisdom, and wealth together, and culture.
Absolutely.
Because what you're really doing there is you're starting with an insight generated by research or education. You're applying that insight. That's a form of culture. You're seeing how that generates an outcome, positively or negatively. That's a form of wealth compounding. And then you're taking that insight, putting it back into that research lens and saying, how do I do it again better? And if you can get that cycle to spin, and you can get it to spin faster, that flywheel to turn, then there's nothing that separates you from whatever goal you have in life, whether that's in sport, in finance, in social circumstances. I think the problem that we often make as a mistake as humans is that somewhere in that journey, we think we have to stop. And we forget that wheel turns by itself when you're trying to make it. We get an insight and we choose not to apply it because it's too hard, it's too complex, or there's noise around analyzing, did it work or not? So we say it was too hard to understand if that was a good decision. And we keep doing it again and again without actually ever checking. Or we forget to go back to research and education and say, what is actually the facts telling us? Is this a good idea or not? Our politicians are often very susceptible to forgetting that last piece. But I think we can all, whether it comes to our wealth or any other problem that we're applying, you can start with that bedrock of that foundation of saying there are three things that compound. There's going to be a lot of noise and a lot of complexity in here. But if I just focus on those three and I start with an insight, I test it and I iterate, then I know that compounding is going to get me there much faster than I think. It's that lovely old joke, you can't cross a 10-foot chasm in 10 one-foot leaps.
And that's actually probably a good place for us to transition to the end of this particular episode. You've alluded to the compounding of wealth, the compounding of education, and the compounding of culture. And they're the big things that we're going to focus on in this podcast. We want to help you here at TIP Group. This is what we want to do. We want to help you compound your wealth and compound your education. So if you'd enjoyed this conversation that we've had today, we're going to have many more. I'd encourage you to subscribe to this podcast. If you'd also like to know a little bit more about our methodology and how we invest, we run a series of webinars. Jump onto the TIP Group website. You can register for webinars. They're online. You can also jump on and subscribe to our email list where we'll keep you up to date with everything that's happening within the TIP Group. Well, thank you, gentlemen, for your time and your wisdom today. It's been a pleasure, and I look forward to our next episode.
Thanks,
Thank
Kerry.
you very much.
Thank you for joining us on this episode of TIP Wealth Builders. We hope you found today's discussion insightful and inspiring. If you'd like to learn more about TIP Group, Teaminvest, or our unique investment approach, visit us at tipgroup.com.au. And don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.